Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Let's kick things off with DFI Retail Group, trading under the ticker D01 on the SGX. This retail giant operates supermarkets and convenience stores across Asia, with brands like Welcome, Cold Storage, and 7-Eleven in their portfolio. DFIRG just released their full-year results for 2024, and there's quite a bit to unpack here. The company posted a solid 29.7% rise in underlying profit, reaching $200.6 million compared to $154.7 million in the previous year. This profit growth came despite a 3.3% drop in revenue, which fell to $8.9 billion from $9.2 billion. What's interesting is that while underlying profit grew, the company actually reported a net loss of $244.5 million for the year. This is a stark contrast to their net profit of $32.2 million in 2023. Looking at their per-share figures, DFIRG posted a loss of $18.17 per share, down from earnings of $239 a year ago. But here's where things get more positive for shareholders. The company has increased its dividend payout. They've declared a final dividend of $0.07 per share, up from $0.05 last year, bringing the total dividend for 2024 to $0.105 per share. That's a nice bump from the US $0.08 per share paid out in 2023. The stock closed Monday at US $2.12, unchanged from the previous session. This was before the results announcement, so we'll be watching closely to see how the market reacts to these mixed results in today's trading. If we look at DFIRG's business breakdown, their 2023 data shows that food makes up about 35.8% of their revenue, with health and beauty and convenience segments each contributing around 26.6%. Home furnishings accounts for 8.7% of revenue, with other sources making up the remaining 2.2%. Geographically, North Asia dominates with 72.8% of revenue, while Southeast Asia contributes 27.2%. The company's current PE ratio stands at around 25, which is relatively high and suggests investors have been expecting growth. Their EPS for the trailing 12 months is about $0.88, and they offer a dividend yield of around 3.6% based on the latest figures. With a market cap of approximately $2.98 billion, DFIRG remains a significant player in the Asian retail space. Trading volume for DFIRG has been moderate, with recent daily volumes around 150,000 to 160,000 shares. This is relatively low compared to some of the more actively traded stocks on the SGX, indicating that DFIRG isn't seeing particularly high investor activity at the moment. From a technical perspective, DFIRG has been trading in a range between $106.79 and $26.10 over the past 52 weeks. The stock is currently trading closer to the upper end of this range, which could suggest some strength. However, the mixed financial results might create some volatility in the near term. Looking at the retail sector more broadly, DFIRG faces challenges common to many brick-and-mortar retailers, including competition from e-commerce and changing consumer behaviors. The company's ability to grow underlying profit despite falling revenue suggests they're finding ways to improve operational efficiency, which is crucial in this competitive landscape. Now let's move on to Jardine Matheson Holdings, trading under the ticker J36 on the SGX. This Hong Kong-based conglomerate has interests across various sectors, including retail, property, motors, and financial services. They've also just released their full-year results for 2024, and the picture isn't quite as rosy as they might have hoped. Jardine Matheson reported an 11.4% decline in underlying profit, which fell to $1.5 billion from $1.7 billion in the previous year. Revenue also dipped slightly, down 0.7% to $35.8 billion from $36 billion. Similar to DFIRG, Jardine Matheson also swung to a net loss, reporting a loss of $468 million compared to a profit of $686 million in 2023. On a per-share basis, the company posted a loss of yuan 61, down from earnings of 2.37 a year ago. Despite these challenges, Jardine Matheson has maintained its dividend at $2.25 per share for the full year, with a final dividend of $1.65 per share to be paid on May 14th. This stable dividend might provide some comfort to shareholders amid the disappointing results. Jardine Matheson's stock closed up 0.5% at $39.70 on Monday before the announcement. The stock has been trading between $39.44 and $39.98 in recent sessions, with trading volumes around 114,000 shares. Over the past 52 weeks, the stock has ranged from a low point to a high of $46.43. The company's dividend yield stands at about 5.5%, which is quite attractive in the current market environment. This high yield might be one reason investors continue to hold the stock despite the challenging financial results. Looking ahead, analysts are projecting Jardine Matheson's revenue for 2025 to be around $34.55 billion, which would represent a 4.15% year-over-year decline. However, EPS is expected to rebound strongly, with projections of $4.76, which would be a 101% increase from current levels. These projections suggest that while top-line growth might remain challenging, the company could see significant improvement in profitability. Jardine Matheson operates in diverse sectors across Asia, which provides some insulation against downturns in any single market. However, the conglomerate's exposure to property and retail sectors in particular has likely contributed to its recent challenges, as these industries have faced headwinds in key Asian markets. Now, let's shift gears and talk about a major development that could impact the Singapore financial landscape in the coming year. The Singapore exchange SGX has announced plans to list Bitcoin perpetual futures contracts in the second half of 2025. This is a significant move that positions SGX at the forefront of traditional exchanges entering the cryptocurrency derivatives market. For those who aren't familiar with perpetual futures, these are contracts that allow traders to speculate on the price of an asset, in this case, Bitcoin, without an expiration date. Unlike traditional futures contracts that settle on a specific date, perpetual futures can be held indefinitely. They're particularly popular in the crypto world because they offer flexibility and leverage. SGX's move comes as institutional interest in digital assets continues to grow globally. The exchange will be targeting institutional clients and professional investors exclusively, with retail customers barred from trading these instruments. This approach aligns with Singapore's careful stance on crypto regulation, aiming to foster innovation while protecting retail investors from excessive risk. The timing of this announcement is interesting, as it coincides with a global shift in attitudes toward cryptocurrency. In the United States, the pro-crypto agenda under President Trump's administration has boosted demand for digital asset exposure. This changing regulatory landscape is encouraging traditional financial institutions to explore cryptocurrency offerings more actively. SGX isn't alone in this trend. Japan's Osaka Dojima Exchange, which has a history dating back to the 18th century, is reportedly planning to seek approval to list Bitcoin futures as well. Additionally, EDX Markets, a crypto asset firm backed by Citadel Securities, announced plans earlier this year to offer crypto futures in Singapore by early 2025. What makes SGX's offering potentially attractive to institutional investors is the exchange's strong reputation and credit rating. With a Moody's rating of AA2, SGX offers a level of security and trust that many crypto-native exchanges can't match. This could help bridge the gap between traditional finance and the crypto world, providing institutions with a regulated and secure way to gain exposure to Bitcoin price movements. The introduction of Bitcoin perpetual futures on SGX could have several implications for the Singapore financial market. First, it further cements Singapore's position as a leading financial hub in Asia, particularly for digital assets. The city-state has been working to establish itself as a crypto-friendly jurisdiction with clear regulations, and this move by SGX aligns with that strategy. Second, it could attract more institutional capital to Singapore's financial markets. Many large financial institutions are looking for regulated ways to gain exposure to cryptocurrencies, and SGX's offering could provide exactly that. This could boost trading volumes and liquidity on the exchange. Finally, It represents another step in the mainstream adoption of cryptocurrencies. When established, regulated exchanges like SGX start offering crypto derivatives. It signals a level of acceptance and legitimacy for the asset class. This could encourage more traditional financial institutions to explore digital asset investments. Of course, the success of SGX's Bitcoin Perpetual futures will depend on various factors, including market conditions, regulatory developments, and institutional appetite for crypto exposure. The launch is still more than a year away, and much can change in the crypto market during that time. Bitcoin's price has been volatile recently, trading around 83,264 with a 10% decline over the past week, according to recent reports. Looking at the broader Singapore market, these developments reflect the diverse nature of SGX-listed companies and the exchange's own evolution. From retail giants like DFIRG adapting to changing consumer behaviors, to conglomerates like Jardine Matheson navigating economic headwinds across multiple sectors, to SGX itself embracing new asset classes like crypto derivatives, the Singapore market continues to evolve and adapt. For investors in Singapore stocks, these developments highlight the importance of staying informed about both company-specific news and broader market trends. The mixed results from DFIRG and Jardine Matheson show that even established companies face challenges in the current economic environment. Meanwhile, SGX's move into crypto derivatives suggests new opportunities may be emerging for institutional investors. As always, it's important to approach these developments with a thoughtful, long-term perspective. Short-term market movements can be noisy, but understanding the underlying business fundamentals and industry trends can help you make more informed investment decisions. That's all for today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and I'll be back tomorrow with more updates and insights from the Singapore market. Until then, happy investing.